Recording in progress.
Hi everyone, welcome back to today's webinar. So today we're going to be looking at the sniper trading strategy. So I'm Melanie, I'll be taking over today's webinar because Desmond isn't feeling well today. But no worries, if you guys have any questions, you can feel free to pop them into the chat and I'll try my best to answer them as best as I can. Okay, we'll just give a couple more minutes. We'll just give a couple more minutes to let more people join our webinar session, and then we can begin shortly. Okay, hi everyone. Just to double check, can everybody hear me? And you can feel free to type it out in the chat as well, so that I can see if our chat function is working. Okay, great. So where are all of you guys from? Oop. Sorry about that. Okay. UK. Okay, we have from UK, from South Africa. We have some from Malaysia as well. Welcome to today's webinar, everyone. How's the weather like where you guys are from? I'm currently in Sydney, Australia, hence my virtual background is a beach. So it's still summer, we're going into autumn soon. So it's getting a little bit cooler. What about for you guys? It's too hot. It's like that as well some days in Australia. Weather is beautiful in South Africa. That's really nice. I've been to Cape Town in South Africa and I miss it. I cannot wait to go back. Okay. Let me just see if all of our participants are here, and then we can begin really shortly. Did you climb the Table Mountain? I did. I climbed the Table Mountain with my dad, and it was an experience that I will never forget. I really want to do it again as well. Okay. Okay. I think everyone is here. Okay, let me just share my screen. Okay, can everyone see my screen? So today we're going to be going through the sniper trading strategy. Once again, I'm Melanie. So I'll be taking over Desmond's webinar for today because he's not feeling well today. Feel free to let me know in the chat if you have any questions throughout the webinar. I'll be monitoring the chat as well as the Q&A section quite closely. Okay. So I'm Melanie. I'm from Everest Fortune Group. We're finalists for Best FX Research and Best Equity Research in 2019, 2020, and 2021. So here's our agenda for today. Firstly, we'll be going through a brief intro to the sniper strategy. After that, we'll be looking at some essentials for Fibonacci retracement, some things to look out for an ideal market structure, such as significant swing highs, swing lows, as well as following market trends. After that, we'll be looking at different Fibonacci retracement levels, and then we'll be zooming in to our sniper strategy, which is our Fibonacci extensions. Or if you guys have been here before, you know the Fibonacci extensions are what we call the Nike ticks. After that, we'll be looking at some examples of Fibonacci confluence areas as well. Okay, let's get started. So here's a brief intro to the sniper trading strategy. So it involves waiting for a high probability trade setup and then taking quick and precise action to enter and exit the market. So why exactly is it called sniper? It comes from the idea that, like a sniper, a trader using this strategy is patient and disciplined and waiting for the perfect opportunity to strike. Okay, my slides have hung. So sorry about that. Give me a second. Let me refresh. Okay. Okay, it should work now. Okay, so sorry about that. So here are some basic steps to follow that are involved in a sniper trading strategy. So firstly, we identify the trend. The first step is to identify the direction of the trend. So this can be done by either looking at price charts or identifying whether the market is in an uptrend, a downtrend, or a range-bound market. Secondly, we'll be looking for key levels. So a trader will be identifying key levels of support and resistance that are likely to influence the price action. So we'll be looking at some of these support and resistance levels, just a few examples in a few coming slides. So these levels may be based on technical analysis, such as trend lines or Fibonacci retracements, or they may be based on fundamental factors, such as economic data or news events. So it's always important to not only focus on your technical analysis, but also make sure that you read the news as well, to brush up on fundamental analysis so that you gain confluence on both when you're trading. So thirdly is to wait for a high probability setup. So this involves waiting for the trend as well as the key levels. So once the trader waits for high probability trade to emerge, you look for specific candlesticks. So specific patterns such as bullish or bearish engulfing patterns, or waiting for a breakout or a pullback to a key level. Next, we want to enter the trade. So once the setup has been identified, the trader will enter the trade with a carefully planned position size and stop loss order, because trade management is very important, and we will go through this later on as well. So the goal is to enter the trade with minimal risk and maximum potential reward. And lastly, managing the trade. So once the trade is open, the trader will monitor the price action and adjust their stop loss and take profit levels as necessary. So the goal is to stay in the trade as long as the setup remains valid and exit with a profit before the trend reverses. Okay, let's get right into it. So here's a brief Fibonacci retracement checklist. So firstly, we want to look for a clear market structure. We want to look for big zigzags, and we'll show you some examples later on. Secondly, we want to identify the recent trend. So are prices going up or down? Thirdly, we identify recent major swing lows as well as recent the highest to lowest for a downtrend, as well as the lowest to highest for an uptrend. So if you take a look at the image here, you can see over here we have a downtrend, which is why we start from the highest and then we end at the lowest, which is our ending point. Next, we're going to be looking at some swing highs as well as swing lows. Here is an example of an insignificant swing. We have movements that are too small, as well as no clear significant swing highs or swing lows. Here's another example. You can see there aren't really any clear swing highs or lows, and price movement is minimal. So here's an example of significant swings. So you want to look for price movement that has clear move up and down with obvious peaks and troughs and clear market movements. Okay, so here's an example of a significant swing. So I've drawn out the peaks and the troughs to point out exactly how clear your price movement should look like. So another thing you want to look out for is following the market structure. So you want to look for clear downward or upward movement. In the GIF over here, we have a clear downward movement. So the Fibonacci retracement trend line will follow the price movement, and it tends to work better on higher time frames, for example, H1, H4 onwards, because there tends to be less noise on these time frames compared to the 1 minute, 15 minute, and so on and so forth. Here's an example of how not to draw a Fibonacci retracement trend line. So your Fibonacci trend line must follow price structure clearly. In this case, you can see there is a zigzag market structure. So the retracement drawn here cuts through the market structure, making it less effective. So when you're drawing a trend line, you want to follow price movement and not deviate from it too much. So here's an example of a clear market structure. So Fibonacci retracements can definitely still be drawn in both choppy and trending markets, but the main thing to look out for is clear market structure. Here's an example of an unclear market structure. You can see how prices are moving up and down quite erratically. Okay, and now let's move on to support and resistance levels. So these levels refer to prices at which assets price tends to stop falling, which would be our support levels, or stop rising, which would be our resistance levels. We're just going to briefly go through like a recap of the different types of support and resistance levels that you can look out for, because these are quite important for your sniper trading strategy. So in addition to these, you can also make use of trend lines, moving averages, as well as chart patterns. But the main thing to look out for would be your swing highs and swing lows that we mentioned earlier. So you can see over here in the image, we're making use of the different swing highs for our resistance levels and the swing lows for our support levels. You can also use these levels as take profit and stop loss levels. However, using a recent swing high or swing low is a weak level if it's only the level, which is why in this case, later on, we'll show you how to get Fibonacci Confluence. So we're making use of different Fibonacci techniques as well as the different support and resistance levels to gain confluence for our analysis. Okay, so when identifying swing highs or swing lows, if at least two swing highs or lows levels line up nicely, it's a much better level to use compared to if there's only one swing low. So we want to try and find areas where these might line up. So it doesn't have to be the exact level as long as it's an area that's good enough. So it's good practice to see how far your resistance or support line can go, as you can see in the GIF that I've included in this slide. So it's okay to cut through small wicks, since these are typically areas instead of specific levels, that you can see in the GIF over here. So how do we pick a starting point for our support and resistance levels? So as I mentioned earlier, it's all right to cut through some candlesticks. Just the wicks is fine. But if you cut through too many bodies of candlesticks, we want to avoid that. So there are a few rules to follow. Firstly, we want to check if there's a swing high or low, pullback or overlap level to start from. Secondly, we want to go back as far as possible. And thirdly, intersecting the wicks is preferred. So as you can see from the image here, the orange thumbs represent an okay intersection. It's not preferred, but it's not exactly wrong. So you preferably want to look for intersections of only the wicks, as you can see from the green thumbs, and we will see more examples in the next few slides as well. So here you can see a red thumb because it's cutting too many bodies of candlesticks. So we should stay away from that. Instead, look out for levels that have clean cuts of just the wicks of the candlesticks, as you can see from the green thumbs on our image here. Okay, here's another example. Take note of the red highlighted area. So once again, we want to avoid intersecting too many bodies of candlesticks, and just focus on just the wicks of the candlesticks. Okay, here we have a big swing high resistance. price surpasses this level and becomes a pullback support where we expect price to pull back or retrace to this level. So over here, we're combining pullback as well as overlap support and resistance levels. So just to give you a brief recap of what we've gone through in previous webinars. So in the green areas, we see price retrace this level and it bounced off of it perfectly. So once price bounces off the pullback support, it now becomes an overlap support. And this is a very strong resistance level to take note of because you can see price has tested it many times before. So it's an important level to take note of. Okay, here's another example. So here we have two swing highs that line up, which makes it a multiple swing high resistance, which in itself is already a pretty strong resistance since we have two swing highs lining up. But after that, we see price surpassing this level, and we expect it to retrace or pull back to this level, making it a pullback support. So we can expect price, since we can expect price to retrace to this level, you want to take note of the two blue circles over here because we see price bounces off this level twice, making it a strong overlap support. Okay, I hope that wasn't too confusing. We have one more example over here, but if you have any questions, feel free to let me know in the chat. So there are multiple swing lows in this example. So they line up at the 33420 support level. Once price breaks this level, it becomes a pullback resistance since we're expecting price to reverse back to that level. So we can see price has tested this level 3 times from the circles. So it makes it a strong overlap resistance level. Okay, so now that at point 4, now that price has once again surpassed the level once again, it's now a pullback support. And lastly, at point number 5, we see it tested this level once again and it bounced off of it, becoming an overlap support. Okay. So now that we've gone through a brief run through of the different kinds of support and resistance levels and what to look out for when you're analyzing, let's dive right into the different Fibonacci retracement techniques. So firstly, we have the negatives, which would be the Fibonacci expansions, followed by the Fibonacci retracement levels, which are the 5 levels, 23.6, 38.2, 50%, 61.8, as well as the 78.6. But in this webinar, we're going to be focusing on the Fibonacci extensions. So the 127.2% and the 161.8%. Okay, so in the GIF that we've attached here, this is the kind of clear market structure that you want to look out for, with your starting point being at a swing high and the ending point being at a swing low. So here you can see all the different Fibonacci levels that we mentioned in the previous slide, and how it looks when it's drawn out. So take note once again of the starting as well as the ending points. So the mid-range would be our Fibonacci retracements from 0 to 100%. And then expansions would be negatives. And then Fibonacci extensions would be the levels that are greater than 100%. So in all 3 of these Fibonacci scenarios or Fibonacci techniques, we are only using one tool, which is the Fibonacci retracement tool. Okay, so Now that we know the criterion for a valid Fibonacci retracement, what exactly is the Fibonacci extension? So the Fibonacci extension levels are levels above 100%, as you mentioned earlier, the 127.2 as well as 161.8. But what we want to look out for are Nike ticks. So if you take a look at the GIF that I've included here, we want to look out for a V shape or a Nike tick as shown here, starting point, ending point. And the tail of the tick should definitely be longer than the distance between the starting and ending point. So now we see price was originally at the 127.2% level in our video, but you can watch as the reactions play off of these two levels and test both of these two levels eventually. So I'll just let you take a look at the video once again. So it's currently at the 127.2% level. We are expecting price to break through this level and hit towards the 161.8% level. And then we are expecting it to reverse off this level and play off of that specific level. Okay, let's move on. Okay, here we have an example of a Fibonacci extension. Here we take note once again of the starting point as well as the ending point. If you take a look at the yellow arrows, you can see a very clear Nike tick. And now you can see price is currently at the 161.8% level, resulting in a reversal. So the red arrow represents the reversal. So every time we have a Nike tick, we expect price to reverse off of the 161.8% Fibonacci level. Here's another example. So you can see how the daily time frame. So this image shows the daily time frame. You can see there's a swing high, which is in line with the 127.2% Fibonacci extension. So if we zoom in, over here, if we zoom in, this is on a H4 chart, so we get a clearer view. So you can see how price reversed nicely off of the 127.2% level. Also take note of the shape that you want to look out for when you're using this strategy. Over here, this is an example. So the previous two examples, we've been looking at upright Nike ticks. Over here, we have an inverted Nike tick. So the starting point is here, ending point here. So take note of the swing low support at 0.91565. So this is in line with the 161.8%. So it makes it a pretty strong support level where price bounced off of, as you can see from the blue highlighted box. So you can see price bounced off of this level because of the confluence it has with the swing low support together with our Fibonacci extension level at the 161.8 level. So we'll talk a bit more about how combining different Fibonacci methods as well as the support and resistance levels can actually increase the accuracy of your analysis in the next few slides when we go more in depth in Fibonacci Confluence. Okay. Do you guys have any questions so far? Let me just check the chat really quick. Okay, all good. Let's move on. So now we've gone through valid Fibonacci retracements. Let's go through some invalid ones. So one of the most common scenarios of this is when price makes a lower low. So assuming you are drawing a Fibonacci retracement from top to bottom. So if there are bars on the right that break your ending point, it becomes invalid. We'll show you an example in the coming slide. But there are Fibonacci retracements that are negative, such as the extension levels that we mentioned earlier. We'll touch on these as they basically go beyond your endpoint, yet they are still valid. So those are the only exceptions to when price makes a lower low after passing your ending point. So here's what we mean. So price has broken the 0.0% Fibonacci retracement and has made a lower low. So the lower low portion that we're talking about would be the highlighted area. You can see from the arrow as well. So you always remember to pick the lowest point with nothing on the right side of the ending point. So you want to make sure that your ending point is really the lowest point and there's nothing else beyond it. Okay, so now that we've gone through invalid retracements, let's take a look at Fibonacci Confluence. So the trick to find multiple Fibonacci retracement levels lining up together is so that you can increase the probability of a bunch of Fibonacci retracement levels working versus a single Fibonacci retracement level, which is known as Fibonacci Confluence. So here is our first example. Sorry. So here we have our first example of a Fibonacci confluence. We have the negative 27% Fibonacci expansion over here. So for an expansion, which we didn't go through today, we want to look for a flash symbol. So, or a lightning bolt. So for example, over here, we see the starting point here from the red arrow all the way to the black arrow. This is sort of like a lightning bolt. So we use those for Fibonacci expansions, and those are the negative Fibonacci retracement levels. So then we look at the Fibonacci extension levels, which are our Nike ticks that we mentioned earlier, and those will be the 100. Over here is 161.8%, and you can see the inverted Nike tick over here. If you follow the gray arrow, and then the tail is this first black arrow here. Okay, and lastly, we want to make use of the Fibonacci projection, which we also didn't go through today. But basically for Fibonacci projection, same thing, we want to look for a flash symbol. In this case, the flash symbol would be over here. The same thing as our Fibonacci expansion. But in this case, for Fibonacci projection, we're using three levels, 61.8, 78.6, as well as 100%. So after you've gotten all of those levels, then you take a look at which of those levels line up with each other. So in this case, it's minus 27%, 161.8, as well as 78.6. And you can see because there is such a strong area of confluence, you can see price bounced off of this area. Okay, I hope I explained that clearly. Feel free to let me know if you have any questions. Okay, let's take a look at our next Fibonacci confluence example. So in this example, we have only two Fibonacci methods First, we have our inverse Nike tick. Starting point here, ending point here. And in this case, the 127.2% lines up nicely with the 61.8%. So where is the 61.8% from? Starting point here. So for Fibonacci projection, we use the extension tool on, if you're using TradingView, it would be the Fibonacci Extension tool. So for the Fibonacci Extension tool, you have 3 points, 1, 2, and 3 here. Once again, for Fibonacci projection, we're looking for a flash symbol. So the flash symbol would be like this. And then you can, once you've gotten those levels, then you take a look and see which of these levels line up. So you can see the 61.8% lines up nicely with my 127.2% Fibonacci extension. So once you see these two levels kind of line up nicely, then we expect price to bounce off of this level, which it did, as you can see in the blue circle. Okay. If you're not so sure about the Fibonacci expansions as well as the Fibonacci projections, not to worry, because we will be going through those in the coming webinars, if I'm not wrong. Yeah, we have entire webinars just for the different types of techniques. So for today, we're just focusing on extensions. Okay, so here's another example. So in this example, price broke through the 127.2% Fibonacci level. You can see over here. And in this case, we have another inverted Nike tick. Let me just take a look. We have a upright Nike tick. So the Nike tick would be in this shape here. So starting point here, ending point here. So once price breaks through the 100%, it can be considered a Nike tick, and we're expecting it to hit towards either the 127.2% or the 161.8% Fibonacci extension. Okay, here we see another flash symbol. As you can see from the Fibonacci shape, the Fibonacci trend lines. So hence we have another Fibonacci projection. Starting point here, the middle point will be here at the swing high, and then the ending point will be at this swing low. So as I mentioned earlier, Fibonacci projection, we want to use 3 Fibonacci levels, 61.8, 78.6, and the 100%. So after leaving all of those levels open, then we take a look and see which of these levels line up. So over here, you can see 100% lines up with the 127%. Okay. Take note of how we used, we ignored all of the small price movements and we went straight in for the clear movement in price. So for the big swing highs, the significant swing lows, those are what you want to look out for when you are analyzing. And these small price movements can be ignored. Okay. Okay, so here's our last example. So in this example, we have the negative 27.2% Fibonacci expansion. over here that lines nicely with the 127.2% Fibonacci extension. So once price breaks through this level, because there is a little bit of confluence here, we'll only go in for the buy once price has actually broken out of this resistance level. Then we'll go in for the buy towards this second resistance level here, which is what we've highlighted, the 161.8% Fibonacci extension, as well as the negative 61.8% Fibonacci expansion. So let me just highlight the shapes one more time. So let's start with Fibonacci extension. We want to look for a Nike tick again. So the shape would be like this. Here's the starting point. Here's the ending point. Once price breaks through this 100% mark over here, then we go in for a buy towards the 127.2%. Okay. Now for our Fibonacci expansion, we look for a flash symbol. So that would be a lightning bolt like this. Starting point will be here, middle point at the swing high, and an ending point at the swing low. Oh, sorry. For Fibonacci expansion, it's just 2 points. So the starting point will be at the swing low, ending point will be at the swing high. This other trend line is for the Fibonacci extension. So for Fibonacci expansion, we make use of the negatives, so negative 27.2% as well as negative 61.8%. In this case, we can see how both of these levels line up nicely. So we'll leave both. And then once price breaks through the first resistance level, then we're going for buy towards the second resistance level. Okay, I hope that was clear. Okay, let's move on. What time frame am I using here? Okay, let me just go back. For most of these time frames, we're either using H1, H4, or daily. We rarely use daily though. We only use daily to get the general trend of where prices are heading towards. But for most of our in-depth analysis, so for graphical analysis as well as Fibonacci levels, we either use H1 or H4. And how we decide between the two would be after comparing the two, we see which time frame gives us a clearer price movement chart. Yeah. So it's either H1 or H4. Okay, I hope that answers your question. Let's look at this last example. So over here, we have, once again, 3 Fibonacci techniques. Let's start with the Fibonacci extension, which would be our Nike tick. So our starting point would be at the swing low, ending point at the swing high. It's only considered a Nike tick once it has retraced 100% of the price movement. So we see Fibonacci extension 127.2%. Now, if we take a look, we also see a flash symbol or lightning bolt, or as Desmond likes to say, the Harry Potter flash symbol. So here we have Fibonacci expansion as well as Fibonacci projection. So since both of these techniques require, or rather they use the flash symbol, most of the time you can use them in Confluence. So let's take a look at Fibonacci expansion first. The starting point will be over here at the swing high. ending point would be at the swing low, which would give us, since we use negatives, we take note of the negative 27.2%, which lines up with the 127.2%. Now, if we take a look at the Fibonacci projection, we use 3 points, as you can see from the orange arrow. Starting point would be at the swing high, middle point, swing low, and then the ending point would be at this swing high over here. So we use 3 levels, 61, 78, and 100%. Here you can see the 100% lines up with our previous 2 levels that we mentioned earlier. So since we have all 3 Fibonacci techniques that line up at the same area, this gives us a strong confluence area, and we're expecting price to bounce off of this strong support level. And you can see that's exactly what price did. It bounced off of this area, as you can see from the purple highlighted area. So you can have your entry at either of these levels, and then once it bounces off, you can go in for the buy. Okay. So this is our last example for the Fibonacci Confluence. You can let me know if you have any other questions. Now let's take a look at trade management. So stop loss is, we like to put our stop loss beyond and our take profit before. So what exactly does this mean? If you take a look in the image here, our stop loss is placed beyond a key Fibonacci confluence area. The reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before the confluence area instead of beyond, you are likely to be stopped out before the market reverses. So this is one of the reasons why most people wonder why they got stopped out right before, and then they start complaining about stop hunting. Next, if we look at take profit, if you place it before, it means that you should always put your take profit target before a key confluence area. Once again, the reason for this is because when price reaches the Fibonacci confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. And this is one of the reasons why people complain that the market is being manipulated, because they missed their take profit by perhaps 1 pip. So if you're still not sure what I'm talking about, you can take a look at this image here. This is also on the Forex Army website. If you go on to the forexarmy.efgmethodology.com, you can see this as well as a few more things that we've gone through today quite briefly, but they go through it quite in depth on their website. So you can go ahead and check that out after this webinar. And yeah, that brings us to the end of our webinar. So thank you guys so much for coming today. Before you go, I just want to share the IronFX VIP room with you guys. So all of the information can be found on IronFX.com. If you just take a look at how to access our VIP trading room, all of the details are over here. And the minimum deposits required for the different tiers are also listed here as well. Yeah, all of the information is here, but I'm just going to go through what you can expect from the VIP trading room. So this is an example of what you'll see. You'll get a welcome page to the channels, and then there'll be, so firstly, there's a trading discussion So you can list out all of the different news, and you can ask all of our pro traders for their opinions on the different news articles. We also have potential setups over here, training videos as well. And then you can also request for any analysis that you like to see. We also have different news channels. So you can see today Desmond posted key news events for today, what we can expect, central bank notes, and our bias for the next 24 hours. So these are done for euro, pound, dollar, yen, Aussie Kiwi, oil, as well as gold. So you can also go onto the different majors. For example, over here I have DXY. If you go in, and firstly, all of our pro traders will be listing out the different analysis for the day, almost every single day. So you can see what they have to say about the charts for each day. And if you take a look at view analysis, if you go over the highlighted points, it will show you exactly what we are talking about, exactly the points that we're talking about. First resistance level will be highlighted for you. So it's all very clear as well. And you can do your own analysis on this as well. This is, it's kind of like a trading view account for you. So you have your Fibonacci retracements for you to practice, as well as horizontal rays for you to practice your support and resistance levels. And then you can type out your analysis. You can tag either Desmond or me or any of the other pro traders and ask them for their opinions on your analysis. And it's a great way for you to practice your technical analysis and brush up on fundamentals as well. So, yeah. Okay. Yeah, I hope you guys enjoyed today's webinar. I hope it was helpful for you guys. And let me know if you guys have any other questions in the chat. And yeah, thank you guys so much. Have a great rest of your day and the rest of your week. How can you use Fibonacci? You mean the tool on the VIP channel, or let me just share. So if you want to use the Fibonacci tool on the channel, let me just use okay, I'll just do this on dollar yen. So if you want to create an analysis for our pro traders to check, here's how you do it. Right, your analysis, you have your bullish, bearish direction. And then if you want to use Fibonacci, you just go ahead and click Fibonacci either retracement or extension. So for extension, it would be what we mentioned earlier, Fibonacci projections. So let me click that. Let me just give you a quick example over here. So this is an example of our Fibonacci projection using the Fibonacci extension tool. If we're using a Fibonacci Fibonacci retracement, this would be for expansions, extensions, as well as retracements. So you can choose your starting and ending points, go into settings, and you can take a look at all of the different levels that we use, and you can just feel free to remove them or add them however you like. If you don't like this colorway as well, you can change it as well. But yeah, this is just the colorway that I have currently. And then once you're done with that, you can highlight the levels that you want to refer to, and then post to whichever channel, and you can add either Desmond or myself, and we can check your analysis for you. Okay, no worries. Okay, thank you guys so much for coming today. Thank you, Scott. Can you use other time frames? Yes, on the VIP channels, you just have to click this time frame over here. There's an arrow down, and then you can choose whichever time frame you wish. I think you said 15-minute, right? Yeah. So 15-minute, we have that as well. Okay, thanks guys. Let me know if you have any other questions, but if not, you can leave the webinar now. Thank you. See you guys. Bye.